We are here to break down the capital maintenance concept today. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that is my sidekick, Terrence. We're here to put the fun in accounting fundamentals. So the capital maintenance concept is one of those things that sounds really complicated because that's what accountants like to do. We like to complicate things, but it can be explained pretty simply. So what it comes down to is a return on capital or a return of capital. Let's say you invest $10,000 in your business, and in the first month, we'll say you have a $10,000 net income. So at this point, the amount that you invested, $10,000, is equal to the amount of net income in the first month. If you take your investment back out of the business, you have a return of capital. You're taking back what you put in. If the business has a net income of $11,000 in the first month and you take out $1,000, you have a return on capital. The money that you invested, that $10,000, has made money. So the money that you're taking out of the business is not your investment, not your capital. It's the money that you made on your capital. So the capital maintenance concept says that a company needs to maintain at least the minimum amount of income that matches the capital of the owners. And that prevents giving away the owner's capital as dividends or withdrawals. So the capital maintenance concept is saying keep the capital level where it is and don't give that away. Until next time, stay balanced, my friends.